Hey, Mike Swanson here. I'm going to talk about 5 stocks that are in trouble. This is the S&P 500. Of course, it's really done nothing since here in July. And actually, that's when the last earnings season was. So we're exactly where we were during the last quarter of earnings, just floating around. Now, there's a couple stocks, though, that I think are best to avoid at this point in time. The first one being Apple. Apple, of course, reported bad earnings yesterday in the close. The stock is down today on that news. But what's more important is what Apple has done over the past year. In July of 2015, it gapped down on a bad earnings report. It's the first time it happened. The same thing then happened in November. This is critical because when you see a company that everyone likes, everyone owns, all the analysts are bullish on, everyone says, say, buy it. Kramer was saying, buy it, buy it, buy it. It's like one of the most widely owned stocks. When you see a stock like that fall on 2 earnings reports in a row, that's a big danger sign that that stock is likely to continue to underperform the market, not just the price action in the stock, but even the baseline fundamentals of the company. And that's exactly what happened to Apple. So when Apple then reported earnings in January, bam, another gap down happened. Now Apple did bounce back up with the market because the market rallied, but then it diverged away in April. Bam, another bad earnings report, hit another bad gap down. And here we are now with another bad gap down. And the red line on the bottom of this chart, if you can see that, compares the action of the stock with S&P 500. That line's in a downtrend. It's been like that since the summer of 2015, meaning that Apple is lagging the S&P 500. When the stock market falls, Apple tends to perform worse than the stock market. When the stock market goes up, it tends to rally less too. As you know, the NASDAQ actually made a new high several weeks ago, but Apple did not. Apple's still way off the high. What does this mean? It means Apple is likely to continue to lag the market averages. It's going to be dead money for people. If you own Apple, if you like that kind of situation, well, I don't know why. In the market, you want to be in the best stocks, the best sectors to make money. You want to make the most money, not to be in this bag holder type situation. And in fact, Apple insiders have liquidated over 16% of their own personal holdings since the summer of 2015. Do what the insiders are doing. Don't be a bag holder for them. And Caterpillar just had a bad earnings report too the other day. Fell on high volume and had a bad earnings report actually in September of last year also. So that's 2. A little bit troubling. The stock isn't as dangerous as Apple is or some of the others I'm going to show you in a moment, but it's kind of dicey. It has outperformed the market on this rally, but I would be putting a stop loss order on it at 75. If Caterpillar is still going to be fine, it'll stay above that. If we fall below 75 at some point this year or next year, it's going to become a very troubled dead money stock. Under Armour is another stock in huge trouble, and as you know, or may not know, in January it gapped down on earnings. It gapped down in July on earnings. It just had an even horrible gap down now. It's below all support levels. That means everyone that's bought the stock in the past year is now losing money. That creates significant resistance. It's going to make it very difficult for Under Armour to stage any sort of meaningful rally. We're probably not going to see it go back above 45 now. It could be years. That's the consequences of a huge gap down. Then the volume was massive. It's a stock that's best to be sold and move that money into a better productive place. Another stock that people love to trade but also lose money on is Twitter. Twitter blew up in 2015, a long time ago, on an earnings report. It did the same thing in August. It did the same thing this April. It did the same thing this July. It's a stock that tends to blow up when it has earnings. It's a highly valued stock. Yes, it was red hot fad in 2014, 2013, but that's not the story now. Now it's a bag holder with people who've held the stock for years losing money, and that creates lots of significant resistance. Now, one thing that happened with Twitter is CNBC promoted rumors that the stock was going to get bought out in September. That caused the stock to gap up. What's his name? I can't remember the anchor that did it, but the rumors turned out to be false. They were denied, and the stock gapped down. And now everyone that bought on that rumor period is getting crushed. No reason to continue to hold the stock. You don't want to hold broken stocks. You want to put your money into stocks that are going up in a sustainable way. Broken stocks aren't fun. And that leads us to a broken sector, biotech. And here's Biogen, a nightmare gap down in summer of 2015, but another gap down in June on earnings. But it's not just the earnings that are bad. The stock has been lagging for well over a year. It's a stock that's in an entire sector that's lagging the stock market. This is a biotech ETF, BBH. That's been actually the worst performing sector in the entire stock market year to date. You don't want to own stocks, much less buy stocks. They're in the worst performing sector of the stock market. You want to be in stocks and sectors that are the best in the stock market, not the worst. So therefore, I have to suggest liquidate any biotech holdings, move that money where money is flowing in the stock market. Where's money flowing in the stock market? Well, one place is the gold stocks, GDX, which is an ETF I've been owning since the beginning of this year, and somewhat before that, with a core position. Yes, we're in a corrective phase, but at the moment, GDX has been among the top ETFs, it's gold stocks, top sectors in the entire stock market. This pause is a consolidation phase. I think it's going to continue longer, but provide an opportunity for anyone who wants to buy mining stocks. And I'm going to talk about that in email updates you'll get from me going forward, and the overall stock market situation, because we are in a very interesting period where volatility has shrunk to nothing. Day by day, doesn't seem like much is going on, but eventually that's going to change, and some huge moves will occur that will take people by surprise. We're not at that moment yet, but we're going to be approaching that moment. We have to have our eyes open for that moment. I will help you do that through my updates. So check your email inbox to